Welcome back. We are busy with Class 7 investments. We are now going to discuss Unit 3.4, which deals with guaranteed products. Right, guaranteed products are usually linked to a long-term insurance policy, such as an endowment policy or a sinking fund. Certain guaranteed products guarantee the initial capital sum invested as well as a growth on a specific index or indices. These indices can be either local or offshore. The guarantee on the return can sometimes be geared up to a factor of the index or indices. During volatile times, investors wonder if they should place their money on call and reinvest when the time is appropriate. The problem is that you never know when the appropriate time is to get back into the stock market. For example, between 1982 and 1990, the Standard & Poor's index grew at 18% per annum. However, if you were out of the market on the 10 best performing days, your return would have declined to 12%. If you missed out on the 20 best performing days, your return would have declined to 8%. And if you missed out on the 30 best performing days, your return would have declined to 5%. Now, that's a differential of 13% from what you could have earned if you stayed in the market. So timing the market is not always a possibility. Only 4% of trading days generate about 80% of the returns. A possible solution is to invest in a product that guarantees you against capital loss, but provide you with some participation in the stock market growth. These products are favored during volatile times in the stock market. There are several guaranteed products available on the market. These amounts are usually invested for a fixed period, generally from 3 to 10 years, although investments for 5 years seems to be the norm. Guarantees must be paid for, generally via reduced returns. However, some will be happy to pay this premium for the peace of mind it brings. These products are particularly useful if the investor does not want to be out of the market, but is nervous about suffering a loss of capital. Guaranteed products allows the peace of mind of knowing that in normal terms your capital will remain intact while still participating in the market. In recent years, some structured products have offered to finance the guarantees by asking the investor to forego the dividend return on the investment. The typical term of these investments is 5 years. Investors should be aware of the importance of dividends in arriving at the total equity return. For example, in 1961 to 2006, the SA equity market gave a total return of 18.9%. Of that return, 4.9% consisted of dividends. So you would have been less 4.9% and would have only received 14%. If one looks at 5-year rolling return on JSE Limited since 1961, one notes that the market gave a negative return in no 5-year rolling period. Certain guaranteed funds that have matured in recent years merely paid the client back the guaranteed amount. Right, let's have a look at multi-manager funds. Multi-manager funds may be the association of several unrelated managers who each manage a portfolio strategy, style, or an asset. The overall manager is responsible for the performance of the total or aggregate portfolio. For example, a multi-manager might split the total portfolio between a growth manager, a value manager, small company manager, financial sector manager, and an international manager. Each blended multi-manager solution must be structured to target a specific market segment and achieve maximum return at the level of risk specified for the product or the specific fund within the product umbrella. In this section, we will discuss the reasons for multi-managers. We look at the multi-manager management process, and we will look at the various multi-manager products offered on South African market. We also examine the factors that determine multi-manager management performance. Right, multi-manager management should be distinguished from a multi-strategy management approach. In a multi-strategy operation, a single manager divides the portfolio that they manage into various assets or market segments. For example, 50% of the portfolio may be invested in growth companies, 30% in value companies, and the other 20% in small cap companies. A market segment may be defined as a group of shares that share similar characteristics and tend to perform as a group over several economic and market cycles. Proponents of the multi-manager management argue that this approach is cheaper than a multi-manager approach, as only one set of management fees is incurred. What are the factors influencing share prices? The basic principle affecting the fluctuation of prices of shares on the stock exchange is that of supply and demand. If the demand for certain shares is greater than the supply, one can expect those prices to rise. If the supply for certain shares is greater than the demand, one can expect those prices to fall. Price fluctuations can also be affected by business cycles. In the upswing phase, business activities increase, and there is likely to be more demand than supply of good shares, which will generally increase the price of the shares. The downswing phase will have the opposite effect on share prices as the mood of the investors become more pessimistic and business activity and hence demand declines. Reports and rumors can often have an immediate and dramatic effect on prices and on shares. Thus, psychological factors such as anxiety or optimism for the future can also play a part in decreasing or increasing the share prices or the prices of shares. Now, we saw this in March of 2020 with the COVID pandemic when that was announced and the markets crashed basically in March and April of 2020. And then they recovered back to higher levels later on. Now, the same thing happened again in 2022, also around about March, when the war between Ukraine and Russia started. We also saw a sudden decline in market prices and stock exchange prices. So all these external factors do have an impact, but usually the market then return after a period to normality. Because South Africa is a relatively open economy, international economy indicators influence the economy as a whole. South Africa's upswing and downswing phases do not usually coincide with those of its main trading partners, but usually follow about 12 or 18 months later. This time lapse can indicate to the discerning South African investor what might happen to the South African business cycle. Right, if we look at interest-bearing investments, both the money market and the capital market channel funds from the economic unit with surplus funds to those units in need of funding. They also consist of the primary market and the secondary market. The money market provides short-term funds to government and corporate sector borrowers. The investors are financial institutions and other lenders with short-term surplus funds available. The instruments of the money market offer high liquidity and low risk. Right, if we look at the interest-bearing investments, some indication of the risk involved in specific instruments of the money market can be seen in the following table. If we look at a 0% risk factor, that would be banknotes, coins, gold bullion, treasury bills, reserve bank deposits, NCDs, central government and reserve bank loans, etc. If you look at about a 20% risk factor, that would be interbank loans and committed capital expenditure off balance sheet. If you look at a 50% risk factor, that would be residential mortgages. And if you look at a 100% risk factor, that could be installment debtors, leases, credit card debtors, overdrafts, fixed assets, equity investments, redeemable preference shares, own bills, promissory notes, and acceptances discounted, other assets and contingents off balance sheet liabilities. Right, the money market can be divided into a primary and secondary market. The primary market refers to the initial issue of the money market instrument. The instruments of the money market are negotiable and transferable. Payments are made to the bearer of the relevant document. For this reason, there's also a secondary market. Right, if we look at the primary market, this market issues the original security for investment. Money flows to the institutions that issues the security. The secondary market, securities are sold by one holder to another and have no direct cash effect on the financial institution that initially issued the security in this market. The difference between the money market and the capital market is usually perceived in terms of the length of the term to maturity of the assets traded. The money market is defined as a short-term part of the financial system dealing in assets that mature in less than 3 years. The capital market constitutes the long-term part of the financial system, being sources of funds that have terms of maturity longer than 3 years. The benefit of investing in a money market fund are as follows. You get high yields, low risk, rarely and any upfront charges, immediate liquidity, the useful parking lot for surplus cash, the spread of investments, and the performance of the money market is published daily and based on a rolling 7-day returns. The three areas in which these securities are issued are thus the private sector. Companies need funds to finance long-term investments. They do this by issue of shares, corporate bonds, debentures, and rights issues. The central government needs long-term funding to finance its expenditure. It is done by issuing long-term government bonds. As an investment with the government is the safest investment one can make. The interest paid by the government on its bonds will be less than paid by other borrowers. Here we are talking about the risk that the borrower may default on payment. It does not consider interest rate or inflation rate. And then municipalities and public corporations issues bonds to finance long-term expansion projects. These are referred to as bonds issued by parastatals. Right, let's have a look at managing a fixed interest portfolio. The belief that it is easy to manage a fixed interest portfolio is wholly misplaced. Several factors affect bond prices, and bond prices can be volatile. For example, a 0.5 increase in the interest rate could reduce the price of a bond with a 10-year duration by 5%. Consequently, investors should understand what affects bond prices and what strategies can be adopted to minimize the risk. We can break down the interest rate return on a bond as follows. Expected interest rate equals the risk-free rate of the interest plus the inflation premium plus the default risk premium plus illiquidity premium plus maturity premium, which is the compensation for increased exposure to the change over the period, plus your tax premium. In an era of real interest rates, capital market instruments offer the investor an alternative to equity investments. Indeed, in the recent years, the pre-tax return on bond issued by the government has often beaten the return on the JSE All-Share Index. Unfortunately, because the interest is taxable in the hands of the ordinary investor, a good portion of his return is paid in tax. Bonds are also less volatile in the short term to the medium term than equities. There is therefore a place for such an investment in most of the portfolios. Bond unit trust provides a convenient method for ordinary investors to invest in the capital market. This then concludes our session. The next one we will look at is insurance as an investment, and that we will cover in Unit 3.4. So I'll see you in the next unit, Unit 3.4, where we will discuss insurance as an investment.